Welcome back to Talk Tickers. This is the deep dive where we don't just read the headlines, we strip the earnings call down to the studs to see how the house is actually built.
We take the transcript, the slide deck, all of it,
Yeah.
and we squeeze it until the truth comes out.
Today we are looking at a giant that is trying to teach itself how to dance. We are talking about United Parcel Service UPS and their Q4 2025 earnings.
And looking at the market reaction, it feels like investors have some, let's say, serious trust issues right now.
Trust issues is the polite way to put it. This is a classic show me story, you know.
Oh, completely. The management team is asking for a whole lot of faith, and the market is gripping its wallet tight.
Right, because if you were watching the ticker, you saw that initial pop. They spiked, 4% right at the open?
The algos love the headline beat.
Yeah.
They just bought it.
But then humans started reading the transcript and reality set in. They faded the entire move to close basically flat, up just 0.3%.
Exactly. The market is basically saying, okay, Carol Tomei, we see the beat, we like the profit, but we are absolutely terrified about the execution risk in 2026.
Because what they're attempting here, it isn't just a pivot, it's a complete re-engineering of their business model while the plane is still in the air.
They're trading volume for margin. They're finalizing a very painful divorce from Amazon.
And they are betting the entire farm on a specific date in 2026.
June 2026. That is the inflection point. But before we get to the crystal ball, we need to look at the scorecard. How did the machine actually run in Q4?
On the surface, it looks like they delivered. Adjusted earnings per share came in at $2.38. The street was sitting at, $2.20?
Yeah, $2.20. So that's an 18-cent beat. In this environment, that's solid.
It is. But I want to pause on that word adjusted. We always talk about adjusted versus GAAP, but here the difference really, really matters.
It does. The JAP number, the actual unadjusted accounting number, was way lower at $2.10.
So where did that 28 cents go? That's not a small chunk of change.
It went into the graveyard of airplanes. They wrote off an entire fleet of aircraft, the MD-11s. We have to talk about that later because it's a huge signal about their strategy.
Okay, but strictly on an operating basis, yes, they beat.
They did.
And the top line was interesting, too. Usually when you hear about massive cost cutting, you assume revenue is falling off a cliff.
Right.
They posted $24.5 billion against a consensus of roughly $24 billion.
A $500 million revenue beat is nothing to sneeze at.
Right.
But, and here's a nuance, revenue was still down about 3.2% year over year.
So the pie's getting smaller.
Right.
So they brought in less money than last year, but more than Wall Street expected, and they squeezed more profit out of it. Adjusted operating profit was $2.9 billion with an 11.8% margin.
That margin number is the hero of the story. And here's the divergence that every listener needs to understand. If you take one thing away, let it be this.
Okay.
Volume is down significantly. Domestic volume dropped almost 11%. But revenue per piece, it's up 8.3%.
That is a massive spread. Usually you see those move in tandem, right? If you sell fewer burgers, you usually make less money unless you drastically raise the price of the burger.
It's almost artificial how wide that gap is.
Yeah.
But it proves the thesis. Their strategy is called better, not bigger.
And it's working?
Mechanically, yes. It is working. They are moving significantly fewer boxes, but they are making significantly more money on every single box they touch.
Which brings us to the elephant in the room. Or really, the elephant leaving the room.
Amazon.
Amazon
glide down. That is management speak for, we are firing our biggest customer.
It sounds gentle when they say glide, but the numbers are violent. In 2025, UPS reduced Amazon volume by 1 million pieces per day.
Just visualize that for a second. 1 million packages every single day. Most logistics companies would kill to have that as their total volume.
And UPS is actively pushing it out the door.
And they aren't done.
Oh.
No. The kicker from this call was the guidance for 2026. They plan to cut another 1 million Amazon pieces per day this year.
Wow. They're effectively firing their biggest, lowest margin customer in slow motion.
They are.
Okay, play devil's advocate here. You can't just drive around with empty brown trucks. You have fixed costs. You have drivers, depots, planes. If you kick out Amazon, what fills the void? Are they just accepting being a smaller company?
They are replacing it with quality revenue.
Yeah.
And this is where the pivot gets technical with unit economics.
Right.
Amazon packages are low margin, they are lightweight, residential, and Amazon just squeezes you on price. So UPS is dumping that to focus on SMBs, small and medium businesses, and healthcare logistics.
Is that actually sticking, though, or is it just a nice idea in a presentation deck?
The data says it's sticking. SMB penetration is now up to nearly 32% of their total U.S. volume.
Okay.
and their B2B mixed business to business improved to over 42%.
So in layman's terms, they are swapping a cheap Amazon box that yields pennies for a complex healthcare shipment or a small business delivery that yields dollars.
Precisely. They are densifying the network with high-value goods. A box of vaccines pays a lot more than a box of tube socks.
But, and this is a big but, that transition is messy. You don't just snap your fingers and swap 2 million packages.
No, you don't.
Mm-hmm.
Which brings us to the CEO's metaphor for 2026. She called it the bathtub.
I have to be honest, when a CEO uses a metaphor like the bathtub to describe my investment returns, I get nervous. It implies I'm going to get soaked.
Well, you might. It's all about the shape of the earnings throughout the year. Imagine the cross-section of a bathtub. You start at the edge, then you drop down.
That's the first half of 2026.
That's the first half. It's the drain.
Why is the first half so bad?
Because the costs of the transition hit before the benefits. They're shedding costs, dealing with the friction of the Amazon exit, taking hits on fleet restructuring. Revenue and margins are going to look ugly in Q1 and Q2.
So we are standing at the edge of the tub, looking down into the porcelain abyss.
Right. And then the back half of the year is the other side of the tub rising up. Revenue and margins accelerate. Management explicitly flagged June 2026 as the inflection point.
They gave a month.
They gave a month. They are telling investors, hold your nose for 6 months, survive the drain. The second half will validate the strategy.
That is a high-stakes poker game. If June 2026 comes and goes without that inflection, the market is going to be unforgiving.
It's binary. If the curve doesn't turn up in June, the thesis just breaks.
To make this work, to survive that drain period, they have to cut costs aggressively. I was looking at the facility closures. It looks less like a haircut and more like a guillotine.
Operational guillotine is the right phrase. In 2025, they closed 93 buildings.
93, that's nearly 2 facilities a week.
And they aren't slowing down. They are targeting another 24 closures in the first half of 2026 alone.
And it's not just buildings, it's people.
It is. They are planning to reduce operational positions by up to 30,000 in 2026.
30,000. That is the population of a decent-sized town.
It is massive. Now, they were careful to specify that this is largely through attrition and a voluntary separation program for drivers.
So not mass layoffs in the traditional sense.
Correct. But the result is the same. 30,000 fewer paychecks going out the door.
But I have to ask the obvious operational question.
Yeah.
How do you cut 30,000 people and close, 120 buildings and still deliver packages on time? Is this just working the remaining drivers harder?
The Teamsters Union isn't going to let that fly.
No. So what's the answer?
Robots. Automation is the key enabler here. They are aiming for 68% of their volume to be processed by automated facilities by year end.
So the network is getting smaller physically, but denser and more automated internally.
Exactly. If you are a listener wondering how they can shrink the footprint without failing deliveries, that's the answer.
Mm-hmm.
They are routing packages through smart hubs rather than manual sorting centers.
Let's loop back to the airplanes. You mentioned the MD-11 write-off earlier. Why does grounding a specific type of plane matter to an investor? Why should I care if it has 2 engines or 3?
Because of the fuel bill. The MD-11 is a classic 3-engine jet. Aviation geeks love them, but accountants hate them. They are old technology.
A gas guzzler.
A cash guzzler. They're thirsty for fuel, they require more crew, and they're expensive to maintain.
Okay.
They grounded the fleet, resulting in a $137 million write-off. They are replacing them with Boeing 767s, taking delivery of 15 of those this year.
Which is a twin-engine workhorse.
It's the Toyota Camry of the sky compared to the MD-11 hot rod.
Again, efficiency over capacity. They don't need the biggest fleet, they need the one with the best margins.
Exactly. Every decision filters through that lens.
Now, here is the part of the call that really made me do a double take. We talked about them firing Amazon, but they're also doing this weird dance with the U.S. Postal Service. Talk to me about Ground Saver.
This is a fascinating pivot. So UPS has this economy product called Ground Saver. It's for the stuff that isn't urgent, the t-shirt you bought that you don't need tomorrow.
Sure. Brown truck pulls up, drops off the package.
But think about the unit economics of that. A UPS driver is one of the highest paid industrial workers in America. Their time is incredibly expensive.
You do not want that driver driving 3 miles down a rural dirt road to drop off a $10 t-shirt.
You lose money on that stop every time.
So what did they do?
They outsource the last mile to the post office. UPS moves it across the country, gets it to the local zone, and then hands it to the USPS carrier who is going to that house anyway to deliver the mail.
Wait, so they are paying the post office, technically a competitor, to finish the job?
Yes, because it purifies their own network. By handing that, trash volume to the USPS, they remove the inefficient stops from their drivers' routes.
It keeps their high-paid drivers focused on high-margin B2B and SMB stops where they drop off 10 or 20 packages at once.
It's ruthless efficiency. If the stop doesn't make money, let the mail carrier do it. It's all about density. Density is the holy grail of logistics.
Okay, let's look overseas. Because while the domestic story is all about efficiency, the international story sounded complicated.
International was definitely the soft spot. Export volume was down. But the real story is the China to U.S. lane. It was down roughly 20.9%.
That is a collapse. A 20% drop in trade volume on the world's most important shipping lane. Is that just the economy, or is that policy?
It's both. But policy is the hammer here. We've talked before about de minimis.
Right, the loophole. But let's define that clearly for the listeners who might not be trade lawyers.
De minimis is a trade rule that allowed packages under a certain value, $800 in the U.S., to enter the country duty-free. It was originally meant for, like, souvenirs you brought back from vacation.
But e-commerce giants like Shein and Temu weaponized it.
They did, to flood the U.S. with cheap packages without paying tariffs.
And the government is closing that tap.
They're welding it shut. The closing of that loophole, combined with new tariffs, has crushed import volumes. U.S. imports were down about 24%.
So if China is out, where is the volume going? Is global trade just shrinking?
No, it's shifting. They are pivoting capacity to where the growth is. Europe and India. They mentioned a new hub in the Philippines opening late 2026, and their Vietnam hub is already running 80% full.
It's a physical manifestation of the global supply chain shifting away from China.
It is.
Yeah.
UPS is literally moving the planes to follow the manufacturing. If you want to know where the next factory of the world is, just look at where UPS is building runways.
Okay, let's touch on tech before we get to the guidance. Usually with logistics, tech means a better website. But they were talking about RFID like it's a revolution.
Smart package, smart facility. And it sounds like marketing fluff, but it actually solves a massive headache.
Which is?
Misloads.
Yeah.
Every U.S. package car now has RFID readers. Imagine you are a driver. You have 200 packages in the back. It's dark. You're in a hurry. If you grab the wrong box, that is a failed delivery.
And that costs money to fix.
Right. With RFID, the truck knows what is inside it. If a package is on the wrong truck, the system screams.
So it eliminates human error.
It reduces it drastically. But more importantly, it's a sales tool. Customers want order-to-cash visibility.
Break that down, order to cash.
It's a finance term. If I'm a business shipping 1,000 iPhones, I can't invoice my customer until they get the goods. I want to get paid. The faster I can prove delivery, the faster I get cash.
And UPS can offer that granular tracking now.
Your package is on the truck. It is 10 minutes away, which allows the shipper to recognize revenue faster. It's a premium service they can charge for.
And speaking of premium services, the Digital Access Program, DAP, seems to be a monster.
It is. Revenue hit $4.1 billion, growing 25%. This is their platform that hooks directly into Shopify, eBay, you name it.
It's the engine room of that SMB growth we talked about.
Absolutely.
So bringing it all back to the investor, we have the strategy, we have the cuts, we have the fancy tech. What is the guidance? What's the bottom line?
And here is the warning label. For 2026, they are guiding revenue to roughly $89.7 billion, which is essentially flat.
Flat.
Margin around 9.6%. And EPS about flat compared to 2025.
Flat doesn't sound very exciting for a turnaround story. If I'm buying a stock, I usually want up.
Flat is actually incredibly ambitious here. Remember the bathtub. To end the year flat, they have to dig out of a massive hole in the first half.
The guidance assumes a huge second half recovery.
A massive one. To offset the ugly start.
So the risk profile is significant. If the first half is ugly, which they admitted it will be, investors might panic before the second half recovery shows up.
That is the bear case. The bathtub is just a drain, the volume never comes back, and suddenly that $1.64 dividend looks very, very expensive.
But the bull case?
The bull case is that the margin holds while Amazon leaves. The stock re-rates. UPS stops being valued as a commodity hauler and starts being valued as a high-quality logistics compounder.
Okay, we have looked at the numbers, we have checked the strategy. Now it is time for the segment our lawyers hate the most.
Please don't sue us.
This is not financial advice. I want you to pitch me a trade based on this earnings call, something wild, something plausible. What do you have?
Okay, I call this the June inflection calendar spread.
I like the name. Break it down for me. What is a calendar spread?
It's when you buy and sell options on the same stock, but with different expiration dates. You are playing the element of time.
Okay, so how do we apply that to UPS?
The logic is simple. Management told us Q1 and Q2 are going to be trash. The market hates uncertainty. So we can expect volatility and fear in the spring.
So we bet against the first half.
In a way, you sell short-dated calls or puts against the Q1 and Q2 earnings. You want to collect that premium because the market is going to be nervous.
And you use that cash to finance the long position.
Exactly. For the long position, you buy aggressive out-of-the-money calls dated for January 2027.
2027, you're going way out.
You have to. You are betting that the bathtub shape is real. You are betting that in Q3 and Q4 of 2026, the margins expand, the better not bigger strategy proves out, and the stock rips higher.
So you feed off the fear in the spring to feast on the greed in the winter.
You use the short-term ugliness to pay for the long-term breakout. If Carol Tomei is right about June 2026, those January 2027 calls will print money.
I love it. It's aggressive. It listens to management's timeline. But again, for the listeners, do your own homework. We are just two voices in your headphones.
Please do not trade your mortgage based on a podcast.
So to wrap this up, UPS is getting smaller to get more profitable. It is a transition year with a very specific timeline. June 2026.
That is the date to circle on your calendar.
And here is a final provocation for you to chew on. They are cutting 30,000 jobs. They are closing nearly 120 buildings. They are grounding fleets. Is this the ultimate efficiency unlock? Or is there a tipping point where you cut so much muscle thinking it's fat that you can no longer lift the box?
That is the question. You don't realize you've cut too deep until you try to flex in the peak season. We will find out if UPS can still lift the weight in the second half of 2026.
We certainly will. Thanks for listening to Talk Tickers. If you enjoyed this deep dive, leave us a review. We will catch you on the next earnings call.
See you then.